Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome Joe Milam. Thank you, Joe, for joining me on our Fortuna Advisors podcast, Create More Value.
Happy to be here. It's nice to see you again, Greg.
Joe Milam is the founder of AngelSpan, the legacy funds, a platform and solution to remove the gamble from funding innovation. Prior to AngelSpan, Joe founded and managed Legacy Capital Management, a fee-based ROI multifamily office. From March of 93 through March of 09, Legacy Capital Management was the top performing large cap core manager in the U.S. based on absolute and risk-adjusted returns. AngelSpan and the Legacy Funds Division, a venture turnkey asset management platform, or VTAMP, is a continuation of Joe's experience as a portfolio manager, angel investor, and entrepreneur seeking to improve the funding experience for entrepreneurs and to drive better risk-adjusted returns for venture investors. He has been recognized as one of the leading voices in improving early-stage venture investing. He has been published multiple times in Institutional Investors Journal of Private Equity, Journal of Portfolio Management, and Practical Applications Journal, and has recently joined the editorial review board of the newly launched Journal of Private Markets Investing. Joe's insights are very valuable for early stage companies, but I also believe they can help seed businesses within large companies as well. So let's get started, Joe, with you explaining what is generally wrong with the entrepreneur funding experience and how does this reduce the subsequent investor returns?
Well, how we fund innovation is the irony is that there's been no material innovation. The idea that an entrepreneur has to go pitch for money from people that are largely untrained, professionally or otherwise, is really at its very core. Coming from the public markets where you're trained, you have a Series 7s, Series 63s, you're registered with the SEC, the CFA, CAIA's designations. There's plenty of professionalization of how serious money is managed in the public markets. The irony is the venture asset class itself is the last financial services industry where there is zero professional standards required of the GPs of venture funds. And then angel groups themselves are largely social clubs. They're not investment clubs because they're really, in a true professional lens, there's not professional investing going on.
So how does your turnkey asset management or TAM work? And how does it improve both the funding experience and the subsequent returns for investors?
Well, the journey of building out, it's called a Venture TAMP, turnkey asset management platform. There are equivalents in the public markets, so we're not inventing that concept. It's literally a platform to establish professional practices. For those of your listeners, if these are folks from the public markets as managements and board members, they're probably well familiar with the 33 Act, the Securities Act of 1933. If you actually read the act, it was established the 33 Act established the first standardized reporting requirements of a publicly traded company. 100 years ago, before the 33 Act, publicly traded companies, the information flow was very similar to the venture world right now. Inside information, you knew the management, you got close. It was the Wild West of information flow. No standardized gap-like reporting structures and requirements, etc. So part of our platform is we built the first 33 Act-like standardized reporting services and platform for startups. Think of it as in proper investor relations. So startups hire us to produce monthly updates and quarterly reports. On the other side of our platform, the Venture TAMP, that's called our Legacy Funds Division, we built what's the equivalent of the 40 Act, professionalizing the venture fund structure and professional practices of managing portfolios on behalf of your LPs in this case, like the mutual funds and ETFs, what's called 40 Act products in the public markets. We're creating 40 Act-like professionalization of the venture fund structure, how to manage risk, how to actually think in terms of risk-adjusted returns versus just chasing the big hot unicorns so that you can have what they call a power law outcome to deliver. That requires a power law outcome to actually deliver decent risk-adjusted returns when you compare it to any meaningful benchmark in the public markets.
When we last spoke, you mentioned Danny Kahneman, somebody who I've followed over the years. I really enjoyed Thinking Fast and Slow. I thought that was a great
Yeah.
book. So, how has your approach been influenced by Kahneman's behavioral finance work?
Well, thankfully, I instinctively followed that sort of Moneyball concept back in the public markets. That's why we were able to be so successful. It's not hard to know, and there's plenty of research way before Moneyball on how the human biases, human emotions impact optimal decision making processes, whether it's investment decisions or not. And as a money manager, I took my fiduciary responsibilities very seriously. So I was always trying to optimize on how I managed our clients' money. And that includes managing my own emotional journey. So I
Hmm.
instinctively applied that sort of Kahneman-esque data-driven approach through a company of which where you and I met, the Holt, the now Credit
Mhm.
Suisse Holt or UBS Holt now. But that
Hmm.
data was my principal data vendor to make objective data-driven decisions. That's where you and I met. And we're very good at it, as you may have recalled. That's what drove largely our ability to deliver such good absolute risk adjusted returns was I designed a process to trust the data, or as I used to tell my colleagues, trust your instruments. Pilots fly
Hmm.
airplanes on their instruments. You've got to trust your instruments. But I was good at building the right instruments, and Holt clearly was a major contributor to that. So the whole concept of Moneyball is absolutely critical. Well, if you apply that same thinking to if you've ever examined how a venture fund makes its decisions, and again, I'm not even talking about angel groups, I'm talking about venture funds, even the most prestigious names that some of your listeners may be recognized. If you actually had the ability to understand what goes on inside those firms, it'd make you want to throw up in your mouth.
Hmm.
Because not only do they lean away from the human biases, but they in fact lean into it and call that their investment edge, their ability to pick winners. That's how they raise money from LPs, the convincing LPs that they know what a good deal looks like. When the realities are that very claim from an intellectual standpoint means they can predict the future. Just like it's long since been known in the public markets, you can't time the markets. Nobody can predict the future, but the VCs actually get by with making those very fundamental claims. And so by instilling just a modicum of discipline and objectivity and intellectual humility, there's actually a way to make compelling risk adjusted and absolute returns in the venture asset class just by instilling some basic disciplines. And that is one of the most important ones. The Kahneman-esque, Moneyball-esque disciplines are one of the easiest and lowest hanging fruit of improving how we fund innovation.
It's really interesting when I think about this in comparison to my work with large public companies as a consultant. I find sometimes almost the opposite problem. When they have small seed businesses within large companies, they very often are imposing too much discipline while the business is still at the sort of very early, really more like the angel phase
Mm-hmm.
than the VC phase, where you should be thinking more about sort of the efficacy of the product, or, things like that, rather than financial discipline and so forth. Very often, large companies underinvest in their up and coming.
Mm.
If you look at the speed with which a company goes from angel to VC to actually disrupting an industry, it can be phenomenal. And a lot of times, large companies that have all the resources in the world to do that do the opposite. They say, well, if you don't have enough profit, you can't, invest anymore in your business, and the rate of growth slows like a snail. Any thoughts on that? I mean, your experience, I know, is with the actual small companies rather than the small companies within large companies. But anything I'm saying sort of ring a bell?
Yes, but one of the things I maybe would caution you at associating what you called more structure and process discipline with bureaucratic inertia.
Uh huh.
I would tell you that is a risk avoidance. You know,
Hmm.
a lot of people that, and I'm overly generalizing, but the way I would view that behavior is more a career risk avoidance,
Hmm.
right? Inside corporate entities, because so many decisions inside corporations, the bureaucratic inertia is career risk. You know, nobody got
Hmm.
fired buying IBM, sort of thing, right? There's a natural avoidance inside a large organization to avoid
Hmm.
innovation because you've got potential career risk at some level,
That
right?
makes a lot of
It may
sense.
disrupt your own business unit that you're the head of. So there are disincentives to actually, and as a result, you apply what you call process discipline, when in fact that is bureaucratic inertia and risk
Hmm.
avoidance and disruption avoidance. So yeah, the corporate structure, the notion of a skunk works, right? Bell Labs, or the old Mac team that Steve
Hmm.
Jobs popularized. When you really are doing innovation, you got to separate it from the corporate structure
Yeah.
because it's a whole different way of thinking. The tempo of decision making is different, right? The experimentation is different. It's not an R&D lab, but it's like an intellectual R&D lab. And that tempo of experimentation has to happen away from the constraints of bureaucratic risk avoidance and/or career risk avoidance. And so that is the difficulty inside large corporations, because you have conflicting agendas. And if you're going to do innovation well inside a corporation, there's an opportunity to do it. But you have to almost learn from how it's been done well in the past, which is that sort of skunk work sort of thing, where you literally separate them from the other bureaucratic entanglements.
Yeah, I believe strongly in that. And I first was exposed to that thinking, even though I came from aerospace, the actual original Skunk Works was in the aerospace industry.
That's right. Yeah.
Lockheed. But the
Right.
the book Bionomics, they talk about in biology how mutations take better when they happen in small pools rather than in like big lakes. When they're in big lakes, the dominant strain tends to knock out anything that's different.
You
But in a small pool,
you create genetic inertia. Yeah.
Yeah.
That's exactly right. No, there is the whole balance of small versus large and what is optimal, and that is there is no singular right answer. It is situational, but there's basic laws of nature that affect small can be nimble. The decision and information feedback loop, if you talk about information theory, is absolutely optimized. Also, when you apply again the theoretical construct of what's called entropic equilibrium, you want the health of any system broadly defined requires entropic distribution of information. And money can be information. Power is information, right? At a higher physics level, you can call that energy. It's a storehouse of energy. But you don't want concentration of information, energy, wealth, money, power, right? Look what's happening with the large social media platforms right now. It's hard to unring that bell when you've got such concentration of information in so few hands. That's a suboptimal system design. So entropic equilibrium is that optimal sweet spot where you have distribution of resources. It could be wealth, it could be access to IP, it could be whatever your storehouse of energy and resource is in your situation or your system. But finding that balance between the two is the sweet spot. And that equilibrium is also best navigated based on, in the startup world, the size of the company. The smaller the company, the higher the tempo. Equilibrium of resource distribution is smaller resources, smaller numbers of people you're distributing it to. As the company gets bigger, you also have to start building structural design so that you're providing entropic equilibrium by carving up team sizes. You don't let teams get really big, right? There's optimal team design. That's really why you do that. It's finding that resource distribution efficiencies and finding that sweet spot of what's called entropic equilibrium. And in venture world, what do we have happening today is we're having greater and greater concentration of money going into fewer and fewer venture firms. They're swinging for the fence with very big checks being written. And it's a colossal waste of innovation capital. And while in a healthy entrepreneurial ecosystem, you want a lot of small experiments. That's what Silicon Valley originally was a lot of small experiments. And having money distributed to a lot of small experiments until somebody gets traction and finds their sweet spot of product market fit and a lot of those elements of success in the startup journey. But you've got to be able to fund a lot of smaller experiments. And there's ways to do that well. And that's what our Venture TAMP is actually designed to optimize on, so that a lot of entrepreneurial experiments can be solved for and funded efficiently. And they're not spending an inordinate amount of time trying to find investors' dollars. But risk is being managed at a portfolio level and a variety of other means by which that the investors can also be confident they can fund a lot of experiments and have their capital deployed in a way that, and I know we're going to talk about the Kelly Criterion. You know, I talked about the Kelly Criterion. That's what informs the capital deployment process over multiple rounds. How do you optimize the total return through the Kelly Criterion is an optimization framework.
Yeah, let's go right into that. I had something else I was going to ask, but I'll hold off on that for now. My partner Marwan Karame is a Kelly Criterion geek. He brings it up very frequently with me, so he's going to love this part of the talk. But and you mentioned it, also on our last call. So, what aspects of the Kelly Criterion have you used, and how do you apply the thinking to your approach?
Well, it's taken a long time for the venture industry to understand the importance of basic fundamental tenets of portfolio management. And one of those fundamental tenets is, again, you can't predict the future. And when you turn the lens around and research venture capital, the number one thing that defines success or failure is simply timing. Well, in market theory, that is systematic risk or timing risk. And the mechanism that you manage systematic risk or timing risk is what's called dollar cost averaging. Not a foreign concept if you're a public market investor.
Mm-hmm.
Well, that really needs to be applied in the venture asset class. Invest over multiple rounds. Okay, because you don't have the benefits of liquidity to sell, you have to stage your capital deployment into any companies you're interested in investing in over multiple rounds to mitigate the timing risk, dollar cost averaging. But again, because of the lack of liquidity to sell something that might not be working, you have to manage how much money you invest of your total pool of capital at the seed stage across a variety of startups, properly diversified. So that then as the winners start matriculating up, as the cream starts rising, those companies that are getting traction, those experiments are working, you've held back enough capital to double down. And the Kelly Criterion is the statistical optimization of how much money you use for your experimentation phase. There's another optimization model called multi-arm bandit, and it comes to the same conclusions because they both use poker models because poker economics are very similar to venture economics.
Mm-hmm.
Very similar. You have asymmetric upside returns, and if you have a bad hand, you lose all your money on that bet of that hand. That's like venture. So how can you optimize on your total pool of money? Whether it's Kelly Criterion or multi-arm bandit, they both say the same thing. In your data gathering phase, okay, that's your table stakes. So you start getting information advantage. That's 15%. That's what Kelly and multi-arm bandit say. And then as the cream starts rising, you start getting information advantage of better performing companies. Then you double down on those companies. That would be their A round. And then you wait more, and the timing risk gets mitigated because the longer you wait, the more the timing risk dissipates and more it becomes clearer and clearer which of those early seed stage companies actually have good management, actually have something the market wants, actually knows how to build a company.
Mm-hmm.
And that, so by the B round, now you've got a clear indication. You have a much lower failure rate, and that's where your last chunk of your money goes. So 15, 30, 55 is the ultimate Kelly Criterion allocation to a multi-round venture strategy, regardless of what you choose to be your venture thesis. I want to invest in AI companies. Okay, well, you invest in a broad diversified seed stage because we don't know who the winners are going to be.
Mm-hmm.
Then you hold back. This also optimizes on your IRR calculation because your biggest chunk of money is invested at the latest of the 3 rounds, when oftentimes it becomes a crowded trade where a lot of people are circling on those companies and they want to get on the cap table. And when you've invested across 3 rounds, the first 2 rounds, you've now got pro rata rights to be able to invest your biggest chunk of money in your best deals before everybody, the big VCs come and scoop the thing up.
Mm-hmm.
And those are where you're going to have also the lowest failure rate. So this whole, you don't need a big power law outcome when you're actually deploying capital properly across 3 rounds, optimized on Kelly Criterion-esque capital deployment across the 3 rounds, and maintain proper diversification across the 2 rounds. That's really the research behind the architecture of our Venture TAMP. It's how to execute on that optimal portfolio and capital deployment strategy, regardless of the venture thesis. So you can capture meaningful, nominal, and real alpha.
That's brilliant.
Yeah. It's basic portfolio theory with a little bit of new introductions of concepts, but the concepts themselves have long since been proven in similar economic settings like poker.
And my mind, it goes to the applications of this to large companies with small seed businesses. It should be exactly the same thing.
It's you're playing portfolio manager with shareholder money versus LP's money. Absolutely.
Yeah.
Whatever you want to do. If you want to fund things that you might think could be technologies that disrupt your existing franchise, you should be sprinkling money. Absolutely you should. Or to enhance features on your existing product line. You should absolutely be sprinkling money, and don't try and pick winners. Lean into those over time where they're actually showing the management team can execute. And then if you choose to go buy them eventually, that's a different corporate strategy and bring them in-house. But at the end of the day, at worst, you're getting industry knowledge by sprinkling across a lot of the companies that might be people that could disrupt your existing cash cows. And you should look at it like a portfolio manager.
So let me just set the stage for the next question. So for the audience's benefit, we met when I worked at Credit Suisse. Credit Suisse had acquired Holt. Holt was mostly facing toward investors. I sat in the investment banking area, so I used the framework to advise companies as opposed to advising investors. You were a customer of Holt. You were managing money, and you were using Holt and its cash flow return on investment. It's a another value-based framework, very sophisticated, great tool, and great software too. So you can actually easily, as a user, shuffle through companies yourself without having to have a consultant in the loop or
I
anything
used it
like
for over
that.
20 years, and I lived through when it was, we would fax in our list of tickers, and you guys would go run it on Holt would go run it on a mainframe that they
Hmm.
leased and send us back a stack of paper, and then they migrated to the web and migrated to cloud. And oh yeah, before it was software, I used Holt, and it was still brilliant back then.
So we both attended a Holt conference back then, where the featured speaker was Malcolm Gladwell, and I
Oh,
remember that well.
yes,
Uh,
yes.
you brought him up on a recent call about how he's influenced your work also. Why don't
Oh
you
yeah.
maybe share that?
Oh yeah. Well, again, this is why, again, I did it by instinct or necessity. I think it's a little bit of both. In designing the research process, I my own personal background and pedigrees, I have no MBA, no CFA. I have none of those formal technical training. But I was recognized while I was in college by one of my finance professors, my most impactful ones. I had really natural skills in securities analysis. And then I had 5 years of on the sell side with EF Hutton. I realized that's more of a sales business than it is a real financial analysis business. I had the good fortune of joining this multifamily office there in Menlo Park back in 1990, and then ended up taking it over when my boss died. But I had natural skills at not overthinking things because everybody else on the research committee on that firm were all Stanford MBAs, and they'd read all these institutional reports, but nobody make a decision. Again, it was almost, career risk avoidance.
Hmm. Hmm.
And I wanted to, I was hungry. I wanted to make decisions, man, because I was already confident making decisions because I could have run a hedge fund in college. You didn't have the ability. You didn't have the ability to have committee-driven investment decisions to make. And I was doing it, and I ended up having people give me money. And hell, the brokers at Payne Weber thought I was just this annoying little college student until they started seeing the returns of my account. And then pretty soon they'd come out and say, "What are you buying?" They'd run back and tell their clients. So again, I had a natural instinct and skills, but those skills were deploying what became the whole Moneyball and Blink-like concept
Hmm.
because I saw no value and I didn't have the ability to do analysis, a lot of excess analysis, but I had great instincts. And those instincts were best executed when you focused on the right decision criteria, Kahneman-esque, Moneyball-esque, and made a decision in the blink of an eye, the metaphorical blink of an eye of Gladwell's work. And so when I took over this firm in 1993, I designed the research process around that very concept. And then the Moneyball book came out, and then the Blink book came out 10 years after but I said, look, we're not going to do analysis paralysis because young men and money is a dangerous combination. And so often the other people on decision teams want to put their intellectual fingerprint on something and get credit for it. And they want to contort the analysis and try and inject their own unique insights on something. And all that does is it breaks down the decision-making process. Bat for average, folks. You're trying to swing for the fence to get credit for an intellectual home run. I'm never that smart. I just want to bat for average, right? It really was, even before Moneyball, the concept of let's just make decisions and don't forget who we're serving. We're not serving our own egos. We're not serving our own personal franchises. We're serving our clients. And what's the best way to do that? We're hired to make decisions and manage risk. What's the best way to do that? And that's what we're going to do. Well, it turns out there's a lot of science behind that being optimal. And so a lot of it was instinct, but we literally, and then when Holt migrated to software, as you may recall, I think it was the F12 button, maybe, if my memory's correctly, where once you ran your screens on the flavor of stocks you wanted to do deeper research on, you could push a button and the names and the industry would all get dropped off. So you were only looking at data.
Hmm.
And I held my team to a very narrow window. We would pull whatever the companies made through the screens. We get them down to about 200 names from the U.S. Mid and large cap companies. We were a GARP style, of money management, growth at reasonable price, and we just wanted to bat for average. We're managing old money, wealthy people's money. They weren't paying us to be heroes, and so we would literally do that. And once we got down to about 200 to 250 companies, then we'd push F12 and we'd say, "Okay, boys," and a name would come up. We'd say yes or no, and then we'd move on. It was always yes or no, and we moved to the next one. And then once we circle back on the yeses, we would then reveal them again and we end up owning a lot of them already. Or it might be new names. And then we'd run the same thing through our existing holdings to just on the sell side. We also use technical analytics as well to complement Holt's fundamental work. So, we use technical analytics to refine the timing of our yes and no, the execution of the yeses and the nos or the buys and sells. We learned that early on that you could be a good fundamental manager and still leave alpha on the table by being early on the buy side and early on the sell side. So
Mm-hmm.
we did incorporate some really good technical tools just to refine the timing of our entry and exits. But it really came down to managing the male ego,
Mm-hmm.
right? Because Charlie Ellis of Greenwich and Associates, we subscribed when my boss was still alive. We subscribed to his research, and he used to do roundtables on the East Coast and West Coast once a year. So every 6 months, he had one of these roundtables of the best active managers, and he'd take notes. And then he would produce a little piece in the Greenwich and Associates research. And when I first joined the firm, I started reading Charlie's roundtable conclusions and insights. And thankfully, his research was printed and it was sent out with a perforated seam, so I could tear it out and I put it in my Charlie Ellis file. When my boss died, I opened up my Charlie Ellis file and used that information to design our research process. And these are the things Charlie Ellis said. You got to have a team approach. All optimal is 3, not 5. Teams of 3 is a system optimization, decision-making optimization. You see this in SWAT teams and special forces teams of 3. That was optimal. And you also had to have a team approach. You also didn't want to be doing your own earnings calculation. You don't want to rely on your own intellectual property, right? Because you have an emotional attachment to that. You get anchored in Danny Kahneman's work, right? You get anchored outcomes, whoever's fingerprint is intellectual fingerprints on the design of your algorithm or the earnings per share calculation or. So this was all in Charlie Ellis. I just did what Charlie said. I'm not a smart guy, but I'm pretty good at intellectual disciplines and understanding truths. And Charlie's work would just resonated, and it was easy because our job was to bat for average. Well, if you bat for average and don't go down as much, you ultimately become the top large cap core manager in the United States over both bubbles. Because if you don't go down as much, you don't have to go up as much.
This is really fascinating because in our business, we're helping companies to embrace a more rigorous way of measuring performance and making decisions and planning using economic profit measures. And, we always say to people, like a balanced scorecard sounds like a great thing, but what if 6 measures get better and 5 get worse? What do? It leads to that analysis paralysis you were talking about before, and the inability to make a decision. One of our core principles in our the ownership culture we like to try to put inside a company is more doing and less talking. Right? Your 3 versus 5 people on the team is a good example of that. But
that's right.
We published some research. In fact, it just was republished in the Journal of Applied Corporate Finance. Showing that companies that have embraced economic profit in their incentive plans, some of which have been using this since the early 90s and some of which more recently, on average, they outperform the market by 7% a year. And a lot of it is because having one measure that captures all the other measures makes it simple, right? I mean, either it goes up or it goes down. You don't have this endless meetings. Yeah, but the revenue's up. But the margin's down. Yeah, but free cash flow is this. And, that's
if you align incentives
having some
with
real
the outcome, if you
discipline
align
around
with
it
the
is really
outcomes
good.
you win. It's just basic human principles.
Yeah.
But this is where so many other Machiavellian agendas or instincts or others get in the way of the very simple task of aligning incentives with the outcomes you want.
I'm curious. So one of the investors I've admired for many years, and unfortunately we lost the founder last year, is Renaissance Technologies.
Jimmy Simons. Yeah, sure.
Yeah. So I lived in Setauket, New York. I used to drive past their building all the time. And he, in the 70s and really into the 80s, developed an algorithmic approach to investing that before fees generated almost twice the return of Warren Buffett.
Oh, sure. He's like average north of 40% through the life of Renaissance. Sure.
And it's just stunning. Why do algorithms so often win in investing?
Well, this is Danny Kahneman spoke at the CFA Institute's global annual meeting in 2017 or 18 in Beijing. I've got it if anybody's interested. And I do want to put a pin in that and say, look, for any of your viewers or listeners that find some of this interesting, I love to share the research. So they can reach out to you. You can offer my email and they can reach out directly to me or on LinkedIn because I love to share the research. So I want to say that. But including this, Danny Kahneman spoke at the CFA Institute's meeting, and he said, and he had a fireside chat that they videoed, and I have both of those. But he said, look, algorithms beat human bias. It's not hard to understand that. But simple algorithms beat complex ones. Now, the advantage that Simons had was he probably didn't have exotic algorithms back in the 70s or 80s, right? probably didn't have a lot of data points. He didn't need them because algorithms be human bias. And what was Wall Street but all about human bias and perverse incentives. So it wasn't hard to create that. There was enough performance alpha available just by the discipline of being a quant. And then as technology evolved and kept getting adopted by Wall Street and the investment firms and data was more readily available, his algorithms, I suspect, got a bit more complex, but probably not that more complex. What he relied on was speed. It became speed. Probably is my guess. Simple algorithmic decision framing, but speed to pick up a lot of pennies, but with a huge batting average.
Yeah.
That's it. It's that simple. It's not much different than what we did in the public markets. We just weren't managing money for high frequency in a hedge fund setting. We had separate accounts and transparent commissions and taxable clients. So it wasn't that sort of hedge fund quantity sort of a model that we were pursuing. But I'll bet you money if I were inside there, all those smart people he had, and he was very smart, probably didn't have really complex algorithms. Wait, long story short, that's my thinking. But I don't know. But I would be willing to bet a very expensive a dinner for anybody that wanted to take exception to my perspective and think that what he's got is a really complex, sexy, rocket scientist, three-dimensional, blah. No, I'll bet you money he doesn't. I'll bet you it's just it's a speed advantage and the discipline of being data-driven and having confidence in your instruments, like we did.
And I think they've also been very adaptive over time. I think they developed an algorithm that worked, but they didn't rest on their laurels. They kept trying to improve it.
They kept experimenting. That's exactly right. Because sometimes there is efficient markets do negate the alpha available. That does, but as global markets expanded, and you probably went in different markets, currencies, commodities, who knows, right? Derivatives.
Yeah.
But the basic instincts of simple algorithmic disciplines were simply applied to different asset classes. I'll bet you money that's what it was.
Yeah, this is really good. So before I wrap up, is there anything else that you'd like to share with the audience?
Well, I just appreciate this. It's always fun to talk to folks. For your listeners that might be angel investors, I do want to put a pin in something that is it sounds really pedestrian or boring, but reach out to me. If you have been an angel investor in early stage startups, there's tax advantages for successes and the failures where you can write off actually your losses in angel investing gets taxable income. And it's a better write-off than a charitable contribution. So it's actually a better financial outcome. These things are really important. But the opportunity to solve for much of what we're hearing played out in the political realm and on the media realm of our excess debt, its history has shown the only way to manage structural inflation is through productivity gains that come from innovation. So funding innovation has become even more important today than it's ever been because we've had 40 some years of structural decline in inflation, but that game's over. We also have massive debt that's getting precarious for our country. And the only way is, and we're starting to see the narrative from Besant and some of the others, is we've got to grow our way out of that debt, cap the growth in the debt while the GDP grows faster. And again, that's going to come from innovation. So the importance of funding innovation better, being able to deploy more money more seriously and more successful in innovation has never been more real. Whether you're a corporation, you've got excess treasury dollars or cash on your balance sheet, and you want to both protect your existing cash cows, but also want to be part of what's next and play offense versus defense against international competitors or your own competitors. Funding innovation is absolutely critically important. I don't think it's something you can do casually or as an experiment or as a pet project anymore. I think it's something you have to get a bit more serious about because our economy needs to. We can't continually lose our competitive advantage to China and Israel and some of the other countries that have actually gotten in funding innovation better than America has. And that's been well documented as well. So we're actually playing catch up even in the venture world, notwithstanding some of the headlines that we all read about.
Well, that's a great close. I appreciate that. So we've been speaking with Joe Milam. Thank you, Joe, for joining us for this very important conversation.
Thank you for having me. I appreciate it.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.